Welcome, everybody. My name is Scott Schoenhaus. I'm the Senior Research Analyst covering healthcare technology sector at KeyBanc. We have the pleasure of having CareCloud, which is a publicly traded healthcare IT company that offers a comprehensive suite of software and services to over 40,000 providers nationwide, and have the pleasure of having CFO Bill Korn joining us today. Bill, why don't we just start at the high level for people familiar with your story? What products and services do you offer? Who are your core clients? Just give us a big overview.
Sure. Thanks, Scott, and thanks for having me join you for today. So CareCloud, as Scott said, is a healthcare technology company. Started about 22 years ago. Our founder's wife is an internist, and so our first customers were small doctor practices. The founder's wife is a solo practitioner, so we initially focused on those 1 to 5 doc practices that most of our competitors really weren't focusing on. Over the years we've grown. Today, 50% of our revenue comes from large practices, ranging from 10 doctors to 2,700 physical therapists. We've got about 20% of revenue coming from hospitals. And you sort of fundamentally think about what are the things that doctors care about, and that's really what we focus on to help them get through all the non-medical aspects. Because doctors should be focusing on the patient, helping the patient to be healthy, not worrying about is insurance getting billed, are they getting paid, are they keeping records in HIPAA compliant format. So we kind of take care of all the nuts and bolts and let them focus on the patients.
Great. Let's drill into some of your solutions and offerings. You have a technology-enabled RCM platform. You have a cloud-based software. You have digital health. You have a bunch of other service offerings. Can you walk us through these service offerings and solutions, Bill, where you're seeing the most notable demand in today's current environment from the providers?
Yep, good question. So, I think first and foremost for most doctors, revenue cycle management, which is the fancy term for billing and following through and making sure that the doctor gets paid. I mean, that's really paramount, because if you're the doctor and you do everything right and insurance doesn't pay you, it's kind of hard for you to be able to afford to pay your staff and continue to provide good service. So I think that's kind of the core of what we're doing. But a lot of times we find that in addition to handling the claims, giving the doctors the tools they need, such as the electronic health record that they use to keep notes during the visit, the practice management system that schedules patients and checks insurance eligibility, the patient portal that lets a patient request an appointment or a refill or see the notes from the visits. Putting all that together. And what we tend to do is we kind of bundle it all into one price. So if the doc wants to use the entire platform, they can do so, and there are no extra hidden fees. Of course, if they say, I love my current EHR, I don't want to change, okay, that's fine. You don't have to change. So we are flexible. Some of our peers will say, gee, I'm only going to give you services if you take my whole platform. I'd say we are a little more pragmatic than that. Again, that's what happens when the founder's wife is customer number one, is you learn to listen to the customer and do what they want, which is to give it to them flexibly. Some of the more exciting things that we've done over the last couple of years are really in the area of digital health. And I mean, if we all think back to the sort of the prehistoric times, like 2019 and before, every visit was in person. And we actually added telehealth to our platform at the end of 2019. And we were thinking about offering a new service that would allow patients to connect with our existing suite of doctors. But as we were rolling out the technology and checking it, 2020 happened, COVID, and all of a sudden we recognized that the right way to deploy telehealth was make it available to the existing doctors to see their existing patients. And at that time, it was great to be able to say to our doctors, you've got telehealth, it's built into your app, it's HIPAA compliant, it's built into the patient portal. So, I mean, that was a sea change. But as we think about it, the right way for medicine for most people, it isn't all in person and it isn't all through telehealth. The right way is probably a hybrid, and we're starting to see a lot of interest in that really over the last 9 months or so. And we've introduced a couple of new offerings that I'll talk about that we think are really going to revolutionize healthcare for people. And fundamentally, think about people who got one or more chronic conditions. They're not going to go in person to the doctor every month. That would be a waste of time. But if they don't do that, what often happens is they sit there thinking the blood pressure is under control, the diabetes, everything is fine until they wind up in the ER. And Medicare has been thinking about this, and insurance have been thinking about this for a few years, and sort of started focusing on what's called now chronic care management. Years ago, when Medicare first thought about it, they said, okay, it needs to be an MD, and they need to be in their regular office, and there were enough rules. And by the way, the reimbursement was pretty low, so it really didn't make a lot of sense. And over the last couple of years, they've kind of relaxed things until middle of last year. They finally said, it doesn't even have to be an RN. It needs to be a licensed care manager who's under the supervision of an MD. But if you've got a patient who's got a chronic condition and you have a 10, 15-minute visit, which could be video, it could be just audio. If everything is fine, all you need to do is schedule the next visit for next month. And, it's worth it for us as the payer to pay a little bit for that visit. Let's pay $100, $125 for this visit and make sure that we avoid the $10,000 ER bill. And so we've introduced that offering to our doctors over the last 6 months. And we recognize the doctors don't have the staff to do those visits. So we've said we're going to provide an offering that's sort of turnkey. We can figure out who are the patients that are eligible with chronic conditions. We can do the visits, and in addition to our own people, we've got a third party that we're working with care managers. Eventually, we may start to do some more of that in-house, but day one, we wanted to start with people who were experienced. And we say to the doctor, all you need to do is you're overall supervising the care of this patient. We'll do the visit. We'll be billing insurance on your behalf, and we'll share the fees with you. So this is actually a win for everyone. It's a win for the patient because it keeps them healthy and keeps them out of trouble. It's a win for the doctor because they make some more money. It's a win for the payer because they ultimately pay less.
Lower the cost.
And
yeah.
It's a win for us.
Yeah. So it seems to me, your solutions are a la carte. You don't have to be the one-stop provider. You can, the client can really choose which solutions they want to use you for. I want to talk back to the revenue cycle management portion. Mm-hmm. Obviously, I think that's a big pull forward in demand with staffing shortages and really just, accelerating the billing process. But one of the big public players cited some issues with the payers themselves having staffing shortage issues which held up the payment mm-hmm. cycle and ultimately kind of impaired their fees. Are you seeing that? Have you seen that? Has that improved? Any color on sort of the
Sure.
billing process would be helpful, Bill.
Yeah, I mean, like if you are the insurance company and you're trying to minimize your cost, if there's anything that's submitted in the claim that isn't exactly perfect, instead of giving people a very explicit note and said, okay, here's the one thing that you forgot. No, just say, we have a question, call me. And you put the person on hold for 45 minutes. And if this is a $50 claim, the chances are that the doctor isn't going to be able to have an employee in the US spend all that time. They're just going to give up. So for us, fundamentally, when we think about revenue cycle management, it's got to be technology enabled. You got to have rules. We need to use artificial intelligence that says if it's this insurance company in this state with this particular diagnostic code, these are the 4 things they want to see. And so we need to assemble those 4, and we have bots that will assemble that and pull the records out of the EHR and submit the claim with everything that we know is required to get it paid. So if you do that, 96% of those claims get paid automatically with no human intervention. And I think that's the real key, is getting them paid the first time. And but I would say there's nothing you're going to do that's ever going to make that 100%. Okay. So the next step is you need to have a large team of people, and we've got 3,500 offshore employees. So we've got people who, if it's necessary to get on the phone and wait for 45 minutes, we've got somebody who can do that so that the doctor doesn't need to do it. And that person needs to be empowered to grab the information, to submit what's needed. They need to be familiar with the protocols, and fundamentally they're the ones who are solving the problem for the doctor and getting them paid. And you may say, what's the big deal if 5% of the claims aren't paid? But that may be the difference between the doctor having enough money to hire all the staff they need and feeling squeezed. So we do everything in our power to get them.
They're already running at very thin margins, so that 5% is truly
it's a big deal, right?
To the offshore point, where are the offshore employees located?
Yeah, so we have 2 large facilities in Pakistan and a smaller facility in Sri Lanka, and we've been offshore for almost 20 years now. And for us, I mean, the whole world sort of discovered Zoom and working remotely back in 2020. I will say I personally joined CareCloud. It wasn't even the name CareCloud at the time. I joined in 2013, and we were doing a video conference with our offshore team every day in 2013, and I think probably had been doing it for almost 10 years even at that point. And so we've got people who are in remote locations, but we see each other all the time. People travel between offices all the time. We have offshore people generally working US hours, speaking English, answering a US telephone number. So it's at some point, what's the difference, whether they're working from home or they're working from a large office in in another part of the world? Doesn't really matter.
Yeah. Speaking about sort of international moving parts, can you talk to me about your emerging opportunities? Particularly, you've always highlighted in the Middle East, Saudi Arabia, and whatnot. Can you talk about those international growth opportunities, Bill?
Sure. So, up until now, up through 2022, while we had large offshore employees, they were really captive subs, and all the revenue was coming from US customers. We're starting to see some opportunities in the Mideast, and actually starting close to Saudi Arabia, actually starting in the UAE. They're coming up with some rules, basically doing the same thing the US did 20 years ago, starting to mandate the use of electronic health records. And our perception is they're not going to write different rules. They're not going to have different standards. They're going to look at what's worked for 20 years here. And instead of giving people 20 years to comply, they're going to say, here are the standards. I want you all complying next year, the year after. And so we see that as an opportunity. And we recently spent some time over there in Dubai at the Arab Health Summit, and we recognize that again, if you compare the UAE with the US, in the US, if a hospital wanted somebody working on their systems, pre-COVID, they wanted a person physically on site. And even over the last couple of years, they're generally saying, okay, I really need a US person, who I can see. And well, the UAE doesn't work that way. I mean, it's a relatively small country with a lot of workers coming from other areas. So the idea that we can come in, and we're a US company, public company, acknowledged as one of the leaders in the field, right away, we've got credibility walking in there. And then when we say, by the way, if a hospital needs help, if a practice needs help, and we need a team here, we can bring people in from our office in Pakistan. They love that because they get a lot of people from Pakistan and surrounding countries helping them in a lot of different things. So that actually seems like a good model. And there's one of the hospital EHR vendors who we work closely with here in the US, who has also identified that market. And again, what we do in the US is we have a team from a company that we bought in 2021 that does the technical implementations, the professional services for the hospitals, and they do implementations of MedTech and other hospital systems. So this company is saying, hey, we have the software, we know we're going to need people. You have the people, you're familiar with us. Maybe this is an opportunity for us to really make inroads. So we're pretty excited about the opportunity there. And again, our perception is they'll sort of start with the UAE because they're taking a lead today, and then there's Saudi Arabia, and then there's other areas in the Mideast, and then who knows? I mean, this is the beginning of CareCloud becoming a truly global company, not just global employees, but a global client base as well.
Yeah, so clearly some synergies with having that offshore team there. Let's talk about your recurring bookings versus your customer acquisition costs. When you looked at 2021, you kind of saw a strain with bookings and customer acquisition costs were fairly elevated. I think that was just an industry-wide phenomenon, but we've seen major improvement in 2022, particularly in the last quarter. What's driving that, and what are your expectations going forward in terms of bookings and customer acquisition costs, Bill?
Yeah. So if I go back to the time of the IPO in 2014, we didn't have any salespeople, any marketing people here in the U.S. We were spending 1% to 2% of revenue on sales and marketing, which seems strange, but what we observed at that point is we looked at competitors. They'd spend $1.25 in sales and marketing to add $1 of annual recurring revenue. And we found that we could often acquire companies for 50 cents, 75 cents. So, if the choice to get $1 of revenue is to spend 75 cents through an acquisition or $1.25 in sales and marketing, day one, we said, we have a limited budget. Let's put our resources into the most productive area. So we focused on M&A. And I think, what was interesting was people would say to me, Bill, it's great. You've got 30% compound annual growth rate. It's phenomenal. How much of that's organic? And guess what? How much was organic when there were no sales and marketing people? Not much. So we started to focus on organic a few years ago, but I think what really accelerated it was at the beginning of 2020 when we bought the company whose name we took, CareCloud, because when we went public, we were called Medical Transcription Billing Corporation. 75% of the revenue was medical billing. By 2021, 80+% of the revenue had a cloud-based software component in addition to the services. So CareCloud seemed like a good name, but they'd also built a presence in the marketplace. They built up a brand name. They had a good core team of people. And we started with that team. And again, the way to build a really strong sales team, you need to start with a few good people, and then you can get a bunch more good people to join them. So we've really put a lot of emphasis on the organic sales and marketing over the last couple of years. Really 2020 was the first year we were doing anything. We continued to build up the team in 21. And the good news is, the spending was growing, and we recognize it takes time when you hire people. It takes time when you start a campaign before you get results. So we weren't surprised that our customer acquisition cost was a little higher. It was probably still a lot lower than most of our peers, but it was a little higher. But we really got the benefits of that in 2022. And I think going forward, we're going to continue to emphasize the organic sales and marketing. And there's actually now a couple components, because we talked about CareCloud Wellness. For the first time in our history, we now have products and services we can resell to existing customers that give us new revenue. And in some respects, it's important to be adding new logos, and our core members of our sales team are working on those new clients. And then you got a small team that's working on cross-selling and getting new revenue from the existing clients. Because at the end of the day, you'd like to say all my revenue continues forever, but doctors occasionally retire. Sometimes they'll sell a practice. So, I need to have some new business to overcome that. And I think when you look at 2023, especially as you get to the second half of the year, that's the first time you're actually going to see that in our numbers, that there's enough new organic sales growth going on, that you could really see that. And you didn't see it quite as clearly in 2022, and I think it's probably worth a second to talk about that. One of the companies we bought back in 2020, their two largest clients were two health systems that had been acquired before we bought this company. And we knew that these hospitals were migrating to the systems of the hospitals that bought them. All right, so we knew that revenue would go away. We were told it would probably go away in 2020. It actually went away in the middle of 2022. So if I take the revenue from those two customers out of both 21 and 22, I actually would have shown 7% organic growth last year, which is a pretty good number, probably better than many of our peers. When you look at our guidance for 2023, and again, take those two health systems out of both years, you'll actually see that we've guided the street to a number like 12% net organic growth, which that would be phenomenal. And again,
that's very healthy.
In a company that a couple of years ago, net organic growth was zero, to get from zero to be an industry leader, I don't think most of our investors are thinking about that, and they may have to wait another month or two or a quarter or two to actually see it in the numbers. But when they actually start to see those results come in Q3 and in Q4, it's my hope that at that point people actually start looking at us and say, "Wow, there's real net organic growth here," and I really hadn't expected that.
Yeah, I think what's more impressive about that stat is that a lot of these providers are operating under very strained financial environments, and for them to be spending on a third-party tech platform speaks about your value proposition, right? So 12% organic growth in this kind of environment. Maybe if you said that in 2020, 2021, when they were being flooded with federal money, you could argue that they were all overspending on tech. But to do that in such an environment, I think speaks volumes. We're expecting, well, you saw this in the back half of last year, and still some softening in spending on the technology front from all the large hospital systems. But even if you go downstream to the clinics and family practices, a lot of them have cut their budgets unless you can produce an ROI within 1 year, or if not sooner.
Yeah, and I think that's the value proposition that we bring, because we can tell them, okay, you haven't been able to hire the person in your back office to do this. Guess what? You can pay us. We can do that. We can staff it. We can do that work, and we can do it at less cost than it would have been if you were successful in hiring. And now you don't have to worry about hiring. And so that's been interesting for a lot of practices to think about. Okay, I don't need to control everything myself. I can rely on a third party, and it leverages my capabilities.
Yeah. So what does that mean for margins, Bill? You've guided to about 15% adjusted EBITDA growth in 2023. Can you talk about the margin profile, the puts and takes of what's driving the growth, but then the margin profile itself, and where we should expect that to be longer term?
Yeah. So we have a history of really focusing on margins and cost. And I mean, we talked about the overseas team, and I'd encourage people who have the time in our investor relations website. If you go under company and videos, you look at the offshore video, you'll see a huge facility overseas. You see where the people doing the work are, and there's a 10-to-1 difference in the cost of our employees in Pakistan versus similarly trained and educated people here in the U.S. You go to headquarters. Headquarters is tiny. And U.S. G&A spending, I mean, we're always looking at how do I reduce that? Because at the end of the day, that doesn't add a lot of value to our customers. So, we're always sort of relentlessly focusing on how do I keep my costs down? How do I grow the revenue base without adding more overhead? And I think you'll continue to see that. We did 2 large acquisitions in 2020. Wonderful acquisitions. One of the downsides is each of the companies that we bought had large office space that they weren't really fully utilizing. And guess what? In 2020, 2021, you go to say to landlords, I want to get out of this space early. And they're like, if you pay me the 3 years of future rent with no discount, maybe I'll let you out early. The good news is those two office spaces are actually coming off lease this year. One of them did already, the other one's coming off soon. So there, some of that fundamental overhead that we focus on eliminating is gone. And as we continue to scale and roll out new offerings, we're not adding to back office cost. So we've done this before. We regularly focus on what can I automate. If I can automate it, that's the best. If I can't automate it, and I can do that work remotely and do that work offshore more cost effectively, that's another opportunity to save. So, I mean, that continues to be the way we operate and are going to continue to focus on growing margins. With one exception, we could definitely cut back sales and marketing.
I was just going to mention that because you've been growing that part of your business,
Right.
You just mentioned, so that you
Right.
can get.
We're not, right now our message to our sales team is yes, there's a budget, but you know what? If you're getting a good return on your investment, you can add more people. You want to go to more events, go to more events. Just keep focusing on growing the organic piece of the business. And at the end of the day, if we have to explain to shareholders, all right, we grew twice as fast as expected, but we got 14 instead of 15% growth in EBITDA. I don't think anybody's going to give us a hard time.
So how do you think about the long-term EBITDA margin profile of this business at maturity? Like, where can you be sustained at from an EBITDA margin perspective, Bill?
Yeah, it's an interesting question, because if you think about the fact that we have a software and a services component, I mean, if you wanted to grow the EBITDA margin and focus on just a percent, growing the percent, you'd say focus on more software.
Right.
And there's a little development cost. There's the cost of the Google cloud hosting and stuff. But fundamentally on a percent basis is better.
Yep.
From growing the total dollars is probably actually beneficial to do what we do, which is to think about, I'm giving you services and software. I'm doing things that you can't do yourself. And,
right.
So that will allow me to continue to grow the EBITDA margin. And it may not hit, I may not be able to predict the exact percent that it's going to be at, but it's going to be in the 20s. Will it get to the 30s? It's possible. But then again, we're the low cost producer. We don't necessarily sit here saying, I've got to charge the highest price. In some respects, I'd actually rather charge a little bit lower price, be appealing to my customers, and make my competitors sweat and think about, there's no way I could offer this thing competitively. That's probably the long-term profit maximizing strategy, is to just focusing on growing the total profits and not get hung up on the percent profit margin.
Got it. Makes sense. Lastly, I'd like to focus on your capitalization. You've seen some changes there. And then the last follow-up on that will be on the SVB exposure. If you wanted to highlight what happened, what you've done to resolve it, and where you are today with SVB. But I guess first on the capitalization part.
Yeah, capitalization is a good one to talk about, because I'd say, candidly, we're probably not typical, at least not typical for companies that are our size. We went public in 2014 with 10 million of trailing revenue. We are around 140 million of revenue right now, and candidly, the stock price is less than the $5 price at the time of the IPO. The total market cap of the common is about the same as it was at the time of the IPO. So, what that said to us, and we recognized this years ago, is that selling a lot more common at these prices really made no sense. So we've actually got, at this point, 2 classes of non-convertible preferred that both trade on NASDAQ. And, think about this as a way to get the capital that I need without the restrictions and covenants, in a way that at the point that my common is actually reflecting my value, I can then go sell those shares of common and redeem the preferred. So the preferred trades on NASDAQ. The older preferred has been around since, I think, 2015. We created a new series last year. The ticker is CCLDO. And so that's preferred is selling right now at around $25 a share, maybe even a slight discount today. it pays an 8.75% dividend, but it actually pays that dividend monthly, every month. Yeah. Last dividend was paid last week. It gets paid on the 15th of the month. It got paid promptly on the 15th of the month, as the dividends have for 7+ years now at this point. So it's a good instrument for people who are kind of saying, I want a fixed income. I like that sort of predictable cash payment. For us, it's nice because if I think about growing and paying for acquisitions, paying for organic growth, I don't want to do that selling the shares when they're at a ridiculously low price. I also don't want to get a huge amount of bank debt with covenants that might be problematic. And so we've always kind of resisted that, which then sort of leads me to the SVB situation. So we've been banking with SVB for a number of years. They're a great bank. Ironically, it was about 3 weeks ago that we announced that our line of credit was coming up for renewal in October. We renewed it early, so we announced that it was now going through October of 2025. They increased the line of credit because we're bigger. I'd say most of the time we often aren't even drawing on the line, but it's nice to know that it's there for emergency money if you need it. It's nice to, for example, if you have an acquisition and you want to say to somebody, I can close tomorrow. No strings, no contingencies, and then I'll do the financing afterwards. I'd say overall we were fine with SVB. We didn't have large exposure deposits a week and a half ago when they shut the bank for a day because the money was split across several subsidiaries, and excess balances were swept overnight into a money market fund that was off balance sheet. So there was really actually no exposure. The only little exposure we had to wrestle with, which again turned out not to be a problem, we had one customer who was ready to wire $750,000 that Friday, and we realized, if they wire $750 in, there's a chance that we might lose 500 of it. So we told them hold off till Monday, and we thought about and we did get another bank account ready if we needed it. It turned out we didn't need it because by that Monday, the restriction on the 250,000 FDIC limit was lifted. So everything is back to normal. We've actually sent our customers email saying we're back to normal. Pay us the normal way. Same lockbox, same wire instructions. The other thing that people were a little worrying about was the line of credit.
Yes.
I will say that over the last week, SVB has honored the line of credit, and they said we're open for business as usual. We tried last Monday, could we draw on the line? And they said, sure. And then we drew a little bit more. And so for us right now, everything is business as usual. I'd say we're being prudent. We're talking to lots of other banks about, maybe if SVB for some reason, if there becomes a problem down the road, we ought to have something else lined up that we could go to, but we're not moving our money out. We're not panicking. We're not worried. We're fortunate that there's a lot of things that potentially could have gone wrong. I'm hopeful for the country that the bank survives, but I'd say if it doesn't, we've got other ways that we'll continue to keep ourselves running. So we're not overtly concerned about it.
Well, that's great. Well, that takes us up to the 12:35 minute mark. Thank you, Bill and audience, for joining the CareCloud presentation. If you have any further questions, don't hesitate to email me and I can connect you directly with Bill. But once again, thanks, Bill, and thanks, audience, for joining.
Thanks, Scott, and thanks, everybody.